Hi there, everyone. So today we're going to be covering an energy stock called Sunpower. They're a solar company, and this is what their website looks like. So before we delve into the detail of who Sunpower are, my name is 𝙋𝙧𝙤𝙤𝙤𝙤. You can call me Ifty. I'm Extreme Returns. I've been on the Etoro platform for over a year, but with Extreme Returns just for 5 months. I'm doing okay given the turbulence of the markets. 44 copiers. Thank you to each and every one of them. By background, I'm a chartered management accountant, worked for Unilever and Mars. I've worked in recruitment consultancy and headhunting, and also set up multiple successful businesses, estate agency and car hire. If you wanted to know a little bit more about me, just type in Ifty my story. You'll see this cool cartoon I made. And also I have been featured in the press like the BBC, Independent, Motoring News, and so on. Okay, let's go over to Stockopedia, which is one of my favorite financial sites. Let's find out a little bit more about Sunpower, who they are and what they've done. So Sunpower Corporation are based in San Jose. You can see a map here. That is the heart of Silicon Valley. See, so you've got Google, Facebook, Apple, and all of the big tech companies and lots of the small tech companies as well. Anybody who's anybody is in San Jose. So that's interesting to note that they see themselves more as a tech company at the edge of energy. So Sunpower Corporation is a provider of distributed generation storage and energy services. The company offers solar plus storage solutions. It offers Equinix residential market product, a solar platform utilizing AC panel architecture, and EnergyLink monitoring hardware to combine solar power production and energy management. And also it does go after the commercial market as well. There you go. All right, so you're going to see lots of red here, and that's quite normal for energy companies who are at the cutting edge of solar. So interestingly, if you look at their revenues, it was 1.5 billion in 2016. This is all in dollars, went up to 2.5, went down to 1.8, and then they became consciously a lot smaller. And in 2020, they were just over $1 billion. But crucially, they became profitable at the net profit basis. Now, net profit is very different to say cash flow, because it's all to do with accounting and depreciation and what things you can put into the accounts. But if you look at, where is it, free cash flow. So free cash flow minus $7.24 per share loss. And even today, 2021, they're still negative, which means they're burning through cash. Although net profit, they are making profit on an accounting basis, they're not making money on a cash basis. And that's really, really important. So be aware, it is a speculative company that if their investors decide we're not going to put up more cash and the banks are saying we're not going to lend you any more money, they could be in trouble. So they've got to turn this figure around and make sure that it becomes positive. Now, one thing that you can see here on the CapEx line, so capital expenditure, they were spending a huge amount comparatively in 2016, $1.85 per share on capital expenditure, and it kept on going down. And you can see here, when they became a lot smaller, they more than halved their CapEx. And in 2020, they hardly spent any money on CapEx. And that's the reason why they've been narrowing this gap between their cash burn and their lack of profitability. Having said that, they do have $233 in the bank in terms of cash. So they've got enough money to keep themselves going for at least another couple of years at this rate. All right, so PE ratio 75. Now, the PE ratio is price to earnings ratio. It's the most commonly held ratio for valuation. I don't think it's the best, but that's what a lot of analysts use. So what that means, it's going to take 75 years under current earnings for it to be able to justify its share price. Obviously, you have to look at the future as well. and that's very difficult to do. So if you look at the PE ratio for, just to give you an example, for different markets. So for the FTSE 100, the PE ratio is 16.5. For the American index, it is, let's have a look. Oh, this has only got the UK ones. Hang on a minute. Let's just make it. Let's do that. Here we go. So for the American one, it's 21.1. So when you think of 75, it is very expensive. So that's something to bear in mind, and we'll come on to that in just one moment. Now, very briefly, their share price this time last year was only $3.88, and it went all the way up to 52. So anybody who had this share last year would be very rich if they invested a fair amount. But one thing that you can see in the share price, let's zoom in a little bit, it's very choppy, goes up, goes down, goes up, goes down. It's very, very volatile. Part of that is market conditions, but part of it also is because it's in the sector it's in, energy, solar. So let's look in a little bit more detail about Sunpower. So this is an article I came across in Seeking Alpha. I'm not going to go through the entire article, but I'm going to pick out some parts. So the summary of this article, written very recently, only last week, is Sunpower's operating metrics continue to improve more than expected. Expanding margins and greater market share opportunity could continue to boost earnings significantly. And the passing of a climate bill from the Biden administration could dramatically increase US solar demand and benefit Sunpower. So a lot of this stock the price of this stock will depend upon the climate initiatives of the US government. So here is a neat little chart which talks about the current focus of the market, but how it could potentially expand over time by using different methods and services which they're offering. So I'm not going to go through the entire article, but what I'm going to do is just pick out the negatives and the positives. So first of all, well, let's do the positive. You know what? He's done it. Let's do the negatives. Firstly, Sunpower's fourth quarter revenues of 342 missed Wall Street estimates slightly. I don't think of that as a big negative because it's not a much, it's not way off. But Wall Street do tend to punish companies that don't live up to the expectations even by a small amount. Secondly, Sunpower's core business is solar project development and installation for larger projects such as commercial installations. Revenue recognition can be lumpy, so they get lots of one-off payments for bigger projects, and Wall Street and investors generally don't like that. They like to see smoother earnings. That's what they're saying there. And finally, but again, I don't see that as a major negative. Finally, the author says on the negative side, Sunpower's quarter one revenue guidance is below Wall Street estimates of 337. The positives, despite fourth quarter net revenue disappointment, non-GAAP EPS doubled expectations. All that means is accounting stuff. So the earnings per share is much better than expected. And there are two main segments, residential light and commercial industry. Each quarter blended per watt gross margin is reported, which represents a total dollar gross profits generated divided by total shipments. And they both came out ahead of their targets. So that's that. So look, this is one of the stocks that shouldn't be part of your anchor portfolio. This is one of those stocks that if you're going to have, expect firstly a lot of volatility. And if you think that solar is the future, then a company like Sunpower is the place to be, but don't make it a majority part of your portfolio. Finally, let's just look at major shareholders. So it's largely owned by Total. I think that's the oil company. 51%. and lots of hedge funds and investment managers. Let's just look to see who these people are. Yep, looks like they are, all right, they are. So that's interesting. They're backed by Total, the oil company. 51% owned. In which case, I didn't actually know that, but which case, I don't think they're going to run out of cash because Total will give them money. That makes it much more of a longer term play. And because Total have got such deep pockets, I mean, here the market cap is only 4 billion at the moment. That's in pounds. So I think this is not a bad company to have. I'm going to just give you another example to compare it with, and that's SolarEdge Technologies. Now, this is one that I've actually got in my portfolio. It's a larger company, and if you look at their revenues, it's roughly the same. It's actually slightly bigger, but they've been growing much faster, and they didn't have to downsize. Crucially, they're profitable on the net profit and cash flow basis. So if you wanted an alternative to Sunpower, SolarEdge isn't a bad company to have in your portfolio. And that's one that I've actually got in my portfolio. If you look, there you go, SolarEdge Technologies. So there are lots of companies in this space. I would do my research and pick the one that you think is best. I hope that helped. Thank you very much, guys. Take care and bye.